Welcome. This guide is for you if you are new to the world of taxes in India. We will demystify tax planning and empower you to make informed decisions. Paying taxes is a fundamental civic duty. It enables the government to fund public services. This includes healthcare, education, and infrastructure. Understanding your tax obligations is crucial. Taxes might seem complex, but don't worry, we will break it down into simple terms. This guide will equip you with the knowledge to navigate the Indian tax system. You will learn about different income sources, we'll explain tax regimes, and how to choose the one that's right for you. We'll show you how to file your taxes online with ease. Remember, efficient tax planning helps you save money. You can then use these savings to achieve your financial goals. Let's embark on this journey to simplify tax planning together. Before we dive into tax planning, let's understand how income is categorized. In India, income is categorized under 5 heads: salaries, income from house property, profits and gains of business or profession, capital gains, and income from other sources. You need to report income from all these sources. The financial year and assessment year are crucial concepts. The financial year in India is from April 1st to March 31st. The assessment year is the year following the financial year. You file your tax returns for the income earned in a financial year. For example, for income earned between April 1st, 2023 and March 31st, 2024, you file your returns in the assessment year 2024 to 25. Understanding these concepts is essential for accurate tax filing. Keep in mind that your total income from all sources is considered to determine your tax liability. Now that you have a clear understanding of income sources and the financial year, let's delve into the different tax regimes. India has 2 tax regimes, the old tax regime and the new tax regime. Both regimes have different tax slabs and rules. Understanding these differences is key to choosing the best option for you. The old tax regime has been in place for a long time. It offers various deductions and exemptions that can reduce your tax liability. These deductions are like rewards for making specific investments or incurring certain expenses. However, the old regime can be complex to navigate. The new tax regime was introduced in 2020. It offers lower tax rates. However, it comes with a catch. It eliminates most of the deductions and exemptions available in the old regime. The new regime aims to simplify the tax filing process. It also reduces the need for extensive paperwork. Choosing between the 2 regimes depends on your financial situation. It also depends on your investment strategy and eligibility for deductions. The old tax regime offers a range of deductions that can help you save tax. These deductions are categorized under various sections of the Income Tax Act. Let's explore some of the popular ones. Section 80C is one of the most commonly used deductions. It allows you to reduce your taxable income by up to Rs 115 lakh by investing in eligible instruments. These include Public Provident Fund, PPF, National Pension System, NPS, and tax-saving fixed deposits. Section 80D allows deductions for health insurance premiums paid for yourself, your spouse, children, and parents. This deduction promotes health insurance coverage and reduces your medical expenses burden. Section 24 allows you to claim a deduction of up to Rs 2 lakhs on the interest paid on your home loan. This encourages home ownership and reduces the financial burden of a mortgage. Section 5. The new tax regime, simplicity and benefits. The new tax regime, introduced in 2020, offers a simplified approach to income tax. It features lower tax rates compared to the old regime. This can be particularly beneficial for individuals with lower incomes. It also simplifies tax filing as it eliminates the need to track and claim various deductions. However, opting for the new regime means foregoing deductions and exemptions available in the old regime. This includes popular deductions like those under Section 80C, 80D, and housing loan interest. The new regime benefits individuals with simpler financial situations. If you have minimal investments or expenses that qualify for deductions, the new regime might be more advantageous. It offers lower tax rates and a hassle-free tax filing process. Section 6. Choosing the right path, old versus new regime. Choosing between the old and new tax regimes depends on your individual financial circumstances. There's no one-size-fits-all answer. It's essential to analyze your income, expenses, investments, and eligibility for deductions. Let's consider an example. Suppose Priya earns 8 lakhs per year and has made tax-saving investments of 1 lakh. Under the old regime, she can claim deductions for these investments, reducing her taxable income. However, under the new regime, she won't be eligible for these deductions. In this case, Priya needs to calculate her tax liability under both regimes to determine which one is more beneficial. Similarly, consider Ravi, who earns 7 lakhs per year and has no significant investments or expenses qualifying for deductions. For Ravi, the new regime might be more favorable. The lower tax rates could result in lower tax liability, even without claiming deductions. Section 7. Filing your taxes online. A step-by-step guide. Filing your income tax returns online is convenient and hassle-free. The Income Tax Department's e-filing portal provides a user-friendly interface. Here's a step-by-step guide to help you navigate the process. First, registration. If you're filing for the first time, you'll need to register on the e-filing portal using your PAN card. Next, log in to the portal using your user ID and password. Then select the correct income tax return, or ITR, form based on your income sources. Fill in your details, providing accurate information about your income, deductions, and taxes paid. Verify and submit. Double-check all the information entered. Once verified, submit your tax return. Remember to e-verify your return through Aadhaar OTP, net banking, or other available options. You can also send a signed copy of the ITRV acknowledgement to the Centralized Processing Center in Bangalore. Section 8. Avoiding tax pitfalls. Common mistakes to avoid. While filing your taxes, be aware of common pitfalls that can lead to errors or penalties. Missing the filing deadline is a major one. Filing your tax returns on or before the due date is crucial to avoid late filing penalties. Incorrect personal information can also cause issues. Ensure that your personal information, such as your PAN, Aadhaar, and bank account details, are accurate. Don't ignore TDS credits. Check your Form 26. As for TDS credits deducted from your income, claim these credits while filing your return. Choosing the wrong ITR form based on your income sources can lead to complications. And finally, having insufficient documentation. Keep all relevant documents, such as salary slips, Form 16, and investment proofs, handy. By being mindful of these common mistakes, you can ensure a smooth and error-free tax filing experience. Section 9. Seeking expert guidance. The value of a financial advisor. Navigating the intricacies of tax planning can be overwhelming, especially for beginners. Consulting a qualified financial advisor can provide valuable insights and personalized advice. A financial advisor can help you choose the optimal tax regime. They can analyze your financial situation and recommend the most beneficial tax regime. They can maximize deductions and exemptions, identifying all eligible deductions and exemptions to minimize your tax liability. They can plan your investments strategically, guiding you towards tax-efficient investment options aligned with your financial goals. They stay updated on tax laws, ensuring your tax planning strategies are current. Remember, seeking professional advice can save you money, time, and potential headaches in the long run. Section 10. Your journey to smart tax planning begins now. Congratulations on taking the first step towards understanding tax planning in India. Remember, paying taxes is not just an obligation, but a contribution to national development. By understanding your income sources, tax regimes, deductions, and the online filing process, you can confidently navigate the Indian tax system. Don't hesitate to seek professional guidance from a qualified financial advisor. They can provide personalized advice tailored to your financial goals. As you embark on your journey of smart tax planning, remember that knowledge is your most powerful tool. Stay informed, plan wisely, and make the most of the opportunities available to minimize your tax liability and achieve financial success.